Good afternoon, everybody. It is now right at noon. We're going to give it about 2 more minutes to let a couple of other folks trickle in, and we'll get started here in just a moment. Thank you. All right. Good afternoon, everyone, and thank you so much for joining us today for our market and economic recap now that we're through 3 quarters of 2024. I am Drew Barnes, the Director of Financial Planning here at Traction Financial Partners, and I'll be with Shane Wolfe today, one of our wealth advisors. So we're going to go through a lot of good economic and market data today. We're going to talk a little bit about investing during elections as well. And just a house cleaning item on the front end is we'll do Q&A at the end. If there are any questions, feel free to use the Q&A chat box at any point if questions come to mind throughout the conversation today, and then we'll be sure to get to that at the end. So with that, I'm going to go ahead and pass it over to Shane, and he's going to start things off as we get into the 2024 equity market returns. Then we're going to dive into the fixed income and interest rate overview, economic update, and then we'll wrap up with investing in election year. So with that, Shane, I'll go ahead and pass it over to you.
Awesome. Thanks, Drew. Great to be with everybody. And as we look at our year-to-date returns through Q3 of 2024, when we look at the equity markets on the S&P side, year-to-date, I think this was a little bit of a shock to me, but we're up 23% on the S&P. And over a 3-year cumulative, we're up darn near 40%. And I think that's just proven that the equity markets have continued to be resilient and profitable across the board on the S&P. We'll talk a little more in depth about the S&P and the concentration of what's going on with the top 10 stocks in the market and how that's driving forward a lot of the gains there. Similarly, as we look at like the Dow Jones, not as good of returns as the S&P, but still holding strong, up 15% year to date. This has been an interesting phenomenon as we look at the Russell 2000 as a whole, lagging behind the S&P and the Dow respectively. But when we look at the Russell 2000, an interesting fact that has popped up is only 40% of the companies in the Russell are profitable currently. So we can see that manifest a little bigger as we look at growth versus value. There we can see, which portion the investors are really voting with their dollars on companies that are more profitable versus value. So that's why we've seen a discrepancy between the growth value side. Shifting gears to Europe and Far East and emerging markets, this is pretty typical where we see international markets lagging behind more domestic. So we haven't seen as good of growth there as we've seen more domestically. And then to finish this out, when we look at the NASDAQ This is our tech heavy index where we've seen wonderful growth year to date, up 22% right there. And on a 3-year basis, cumulative growth up 29%. So across the board on the equity side, the capital markets have shown to be very resilient and profitable, especially domestically as we look across here. Okay, so this next slide here, as we digest, where are those profits coming from? So I'll first start on the right-hand side here. When we look at technology, and we'll get to this later, but as we look at technology, a majority of the growth has come through the technology sector. A lot of that has come with AI efficiencies and how that's really helped companies with their bottom line and be more profitable across there. Similarly, as we look at like communication services, think of Netflix, Paramount, Disney. We've seen a lot of advances there with AI technology as well. On the far end side of here, I'll actually jump over to the real estate side. That's been quite a headwind when we look at real estate, especially commercial real estate right now, even more local here in Denver. I know when you look at vacancy rates across the board and with this work from home paradigm shift, real estate could be a definite concern when we look at overall indexes within inside the S&P portfolio. So as we look at areas that are most profitable right now, technology and comm services continue to show that they have found a way to be profitable in this environment. Shifting gears, as we look on the left-hand side here, so here's how to read this chart. When we look at large cap, medium cap, and small cap, and then on the left-hand column, there'll be value, and then blend and growth. And what blend is if you took growth and value and put those together. And our theme here is large cap value continues to show the most profitability across the board on the equity markets. Blend, holding up well, but if we look at, small cap value, we have just seen headwinds there where companies have not been able to show their profitability, and investors are voting with their dollars to put it more towards large cap growth versus any type of small cap value or even small cap growth. All right, so when we look at US stocks, when we had a really good start to the year where we've had through Q1 to Q3, where we've been up more than 20%. When we look at that through a historical lens, going back to 1984 to current day, we're always kind of curious, well, if we start off so well in the first part of the year, how do we typically finish out the rest of the year? So there's only been one time where the markets have been up 20% in the first 3 quarters, but the final quarter of the year it's been down. And that was actually the year I was born in '87 with Black Monday. And if we look historically, how many times has this happened? 10 times? Yeah, 10 times. So when we look through that, and we look at the final quarter, that orange bar there, the full total year return, in Q4, the average gain on that is over 6.5%. So that gives us a good illustration of hopefully how the rest of the year will shake out going forward. When we look at the stock market returns from Q1 to Q3, the first part of the year was really heavy on the top 50 US stocks, US large cap growth, and just larger stocks as a whole really carried most of the weight for where most of the returns came from in the first 2 or 3 quarters of the year. So as we look at on that orange slide there on Q3, where we actually started to see more participation outside of those large holdings, where emerging markets, large cap, value, non-US growth, small cap growth, and US small cap really started to participate and show some gains through there. And really this is when we look at our overall portfolio, this is a good lesson of why it means to be diversified across our portfolio, not just having just large holdings like just the S&P, where we want to have diversified growth across different asset classes. So it's great to see these other asset classes start to perform well and join the party. So we talked about this just briefly earlier, where we talk about what the S&P has done, and we talk about concentration risk and what that looks like inside the S&P 500. So the top 10 stocks in the S&P 500, when we look at the upper right chart right there, that makes up 35% of the whole index. So 10 stocks really are weighing 35% of the S&P 500. And when we look at that, when we look at the remaining, 492 stocks, how is that in relation to their performance? So the current remaining stocks is at a 18.4x versus, our historical average at 15.7 versus, the top 10 are at a 20x. So, the S&P, when we look at that, really, that top 10% or top 10, holdings have really narrowly carried a lot of the weight of the market returns. So that gets us thinking a little bit, is not to raise any alarm here, but our valuations of the S&P in line with historical averages. So this chart shares with us there's a number of ways that you can, price the S&P when it comes to forward earnings or dividend yield or price to book value, price to cash flow. When we look at that in those different valuation metrics, are we fitting within, one standard deviation historically, or are we getting a little overvalued here? So when we look at this chart, it's starting to share with us that we're starting to deviate a little further from our typical one standard deviation on either side. And some of these valuations are putting us a little higher than historical norms. And then I'm going to go ahead and shift this off onto Drew and talk about fixed income and interest rates and where we're at currently in the market.
All right, thank you very much, Shane. So clearly it's been a really strong year for equity markets this year, following a really strong year last year. But it's been a really tough environment for fixed income the last 3 years or so, given the rate of inflation that we saw really take off in 2022. And it's been certainly coming down, but it's been stubborn. So with that high inflation came a really big increase in interest rates from the Fed. And so, our thesis coming into this year as an investment committee here at Traction Financial Partners was I think we're finally at a point where bonds are going to begin behaving like bonds again. And that pretty much is what we have seen. So if we look at the chart on the screen here, this top half, it's how has, various areas of the fixed income market performed this year. And year to date, this US aggregate, that's kind of the primary index that we track in our industry to see how investment grade or high quality bonds are doing. And this is a little after the end of the first quarter, so the end of last week, and bonds are up about 3% roughly this year. And, while that's certainly not rivaling the returns of equities, it's nice to see some decent gains in the bond market, and it was actually higher. And I'll get into this as we move through this section, but we've actually seen interest rates move higher in the market since the Federal Reserve had their interest rate cut back in September. So that's a little bit counterintuitive, and I wouldn't say many folks expected that to certainly, given that the Fed had held rates so high for so long, and then they made a big 50 basis point cut or 0.5% cut. We've seen interest rates go higher. So through the end of the third quarter, the U.S. aggregate was actually north of 3%, but now it's hovering right around 3%. Corporate bonds are up about 4% year to date. So corporate bonds have fared pretty well. And we've seen a reversal. We've seen leadership out of municipal bonds relative to taxable bonds the last couple of years, but not this year. So municipal bonds are positive, but just barely so. And then we have high yield bonds for bonds that are a little more risky and not as high quality. They've done quite well. But if we look over here at the 3-year cumulative return for bonds, we can see we're still down about 5% over the last 3 years. And what really tells that story, if we kind of just pick out the 10-year Treasury bond here, 3 years ago, it was at 1.61%. Fast forward to today, roughly, it's north of 4%. So that's a really, really big increase. And as interest rates go up, bond prices go down. So it's been a tough 3-year period, but it definitely feels like fixed income is starting to, again, be what we expect out of fixed income. It's not necessarily going to hit home runs from a return perspective, but it's really meant to be the ballast of the portfolio and enhanced diversification to kind of smooth out the volatility. So not only have we seen relatively decent returns in fixed income this year, we actually have bonds paying us decent interest for the first time in quite a while. We've seen that the last couple of years. So if we look at the rates from 3 years ago again versus today, the 2-year Treasury was just barely positive. Now it's right around 4%. So just a massive increase in short-term rates, really driven by the Federal Reserve, who was at effectively 0% during COVID to stimulate the economy. And they jacked their interest rates up to about 5.37% at its peak. And then they held the rates there for quite a while before just cutting it last month. And, just a couple of other things to point to. The 30-year fixed rate mortgage, close to the end of the quarter was hovering right around 7%. As opposed to 3% 3 years ago. So, Shane mentioned that real estate sector from an equity perspective, which is more so driven by, commercial real estate in terms of what we invest in real estate stocks. But residential real estate has definitely slowed down a lot from 3 years ago, given this higher barrier to be able to purchase homes for folks that are having to borrow. And similarly, the prime rate, which is the rate that banks lend to companies that are the most creditworthy, so really strong companies, that's up at 8%. So, companies that are having to tap banks to get loans for, projects and things like that, it's really eating into their bottom line a little bit due to these high rates, as opposed to just over 3% a couple of years ago. And one thing I'm going to point out here and dive deeper into in the slides to come is you can see that the 10-year Treasury is actually higher than the 2-year Treasury. And it's called the yield curve inversion, when shorter term rates are higher than longer term rates. And we can see that, at the end of last year, the 2-year was higher than the 10-year. So we've finally gotten back to a normal yield curve in terms of the 2s versus the 10s. And that happened in the beginning of September. Okay, so how did fixed income as an asset class in the various sectors within perform in the third quarter? They did really well. So if we look at that U.S. aggregate, again, kind of that main bond proxy that we track, up over 5% in the third quarter. Muni bonds, about half of that, but still pretty decent at 2.7, pretty good return for just a quarter. Municipal high yield bonds did pretty well at 3. Corporate bonds up near 6. Global high yield up over 6. Treasuries just shy of 5%. and then securitized loans at about 5.5. So you can see those blue bars of their returns for Q3 relative to the average quarterly return for about the last 24, 25 years, meaningfully higher than what we typically see out of fixed income in a given quarter. So kind of back to that yield curve inversion and how we're no longer inverted when it comes to the 10-year Treasury versus the 2-year Treasury. If you kind of track these bars here, the 10 versus the 2 is our gray bar. So we can see here it's finally back into positive territory where we're getting paid higher interest for the 10-year versus the 2-year. And that's normal because normally when you lend your money to someone for a longer period of time, you demand higher interest because there's more risk with the longer the term that you may not get your money back. So normally, the longer the term, the higher the rate, and we're finally back above that break even there. However, in the blue bar, which is the 3-month Treasury versus the 10-year Treasury, it is still inverted. So the 3-month is still higher than the 10-year. And that's because the 3-month is pretty much glued to what the Federal Reserve is doing and where the federal funds rate is. So the Federal Reserve they cut 50 basis points. I said they were at 5.37% roughly. So now they're a little bit below 5%. And we saw that the 10-year is around 4%. So the 3-month is still higher. And one thing to point out here is you can see when we have these inversions, when they get back to normal, these shaded areas are recession. So an inversion, we're back to normal, then we have a recession. An inversion, we get back to normal, then we have a recession, and that theme has played forward. So since 1985, every yield curve inversion we've seen has been followed by a recession. And so that's still kind of the hot debate is whether or not we move into a recession or not. I think the opinion of kind of the marketplace is that as of now, it looks like the Fed may pull off what's considered a soft landing. They raised interest rates high, and then they start cutting, and maybe we don't slip into a recession. So that's something that we're, of course, closely going to be tracking moving forward is history going to rhyme again this time, or are we going to see something different where we don't slide into a recession? But that's certainly something that we're tracking. Now, to the Federal Reserve specifically, this is the Federal Reserve, their federal funds rate here on this gray bar. And you can see again here, they were north of 5. They cut by 0.5% or 50 basis points. So now it's at about 4.88. Now, these blue diamonds and dotted line is what the Federal Reserve, the FOMC, the committee that makes interest rate decisions within the Fed, they're expecting to be, continuing to cut throughout the rest of this year and into next year before kind of finally getting to a neutral level. So they pretty much telegraphed that they expect to be down, another 50 to 75 basis points by the end of the year. And then the market, they're always placing bets to see if they can kind of outsmart the Fed, and typically they don't. But the market is pretty close in line with that. But they're expecting the Fed to be a little more aggressive than the Fed has forecast themselves. So we'll see how that plays out. But we finally have seen some interest rate decreases from the Fed after, as we can see here, one of the fastest rate increasing cycles we've ever seen. After going to basically zero here in 2008, they started to climb up a little bit. They cut back down during COVID, and then we know that inflation really ignited at that point, and they had to jack rates a lot higher. So what does that mean to us as investors when the Fed goes forward with a cutting cycle? So we can see these shaded areas here are Fed cutting cycles going back to about 1984. So those are the last 5 cutting cycles. So what we've seen in equities, it's kind of a mixed bag. And I think it kind of depends whether or not the economy as a whole slides into recession, because when it does, as we can see here, in that, early 2000s recession and then the 2008 recession, the equity markets they fared pretty poorly back then, but there's definitely periods where the equity market has really shot higher. So it's a mixed bag when it comes to equities. But when it comes to bonds, and we look again at that aggregate bond index, bonds tend to really, really do well once the Fed starts cutting. So, here at Traction, we are, I wouldn't necessarily say awfully bullish about fixed income, but we're pretty excited that there's actually finally some return prospects in the bond space so that we can, start getting some juice out of that portion of the portfolio other than just softening volatility. And most of our clients, of course, have diversified portfolios. So a 60% stock portfolio versus a 40% bond portfolio has fared pretty darn well in most of these cutting cycles, again, with the exception of those recessions. But again, adding bonds takes you to a -7% versus -28 and -18 versus -38. So diversification still plays a very crucial role. And we'll see how this rate cutting cycle unfolds. But at a minimum, history tells us that bonds do quite well during these cycles. And kind of to wrap things up here on the fixed income discussion is we have, again, those various sectors within fixed income. These big gray bars are kind of a range over the last 10 years of what yields have been within those respective sectors of fixed income. These purple bars here are the 10-year median. And then these blue diamonds are where things stand currently. So again, just to the point I made just a moment ago, we feel that fixed income's pretty attractive, and we have yields pretty much in every category except for emerging market debt, which we don't allocate really anything to emerging market debt. We see yields above the 10-year median, and so we're not only getting interest that's finally pretty attractive. Again, if bond rates come down, we should see decent appreciation in conjunction with that. So right now is one of those times, as Shane said, the market from a valuation perspective is higher than it's been in a little while. So we feel there's not really much of a need to take on additional risk at this moment because fixed income is pretty attractive. So while stocks have done well, as investors, we don't want to be driving by looking through the rearview mirror. We want to focus on what lies ahead, and fixed income looks pretty attractive. And with that, I'm going to give you kind of the economic update. Now, we're only going to cover a few economic points here, and that's really inflation and labor. And the reason we chose to talk about inflation and labor is because the Fed, the Federal Reserve, has a dual mandate, and that's to keep inflation down. Their target is 2%, and to have full employment. And so for the labor market to be strong. So we're going to focus on those two areas. So the chart we have here is CPI, Consumer Price Index, which is the primary inflation measure. The blue bar is headline CPI, and the gray bar is core CPI. So core CPI strips out food and energy because those tend to be more volatile in terms of their price changes. So it strips those out for core. And I would say that the Federal Reserve focuses more on core. So obviously, as we can see, inflation really spiked high here. And we saw that the headline inflation was nearly double what the core inflation was. And while, there's kind of a misconception out there that since inflation is down, that does not mean that prices are down. Prices are still going higher. They're just not going, the rate of increase has come down, which is good, but it's not to be confused with prices themselves actually going down. So we can see right here that, currently CPI is a little above 2.5%. So it's definitely working its way down to that 2% target of the Fed. Core CPI has been a little more stubborn at about 3.3%. And again, that's the Fed's primary focus more so is that core piece. So the core piece is still, a decent amount above the Fed's 2% target there. This is a makeup of inflation, just going back to the beginning of 2021. So when inflation really ignited, we can see that a large portion of that are these green portions of the bar, and that's energy. So, we all felt it at the pump, and not that we like the prices we're seeing in gas right now necessarily, but they've certainly come down. But energy was a main driver of inflation as we worked our way through 2022. And that really spreads into a lot of other areas of the economy, right? So if trucks are having to pay a lot more for fuel to deliver goods, well, now those goods are going to cost more. So it kind of trickles down. And we've seen now the last, in 2023, energy went down. So we see the green bars actually below 0% here. And then it's remained pretty stable throughout 2024. The big main increase in inflation really the last 2 years is these dark blue portions of the bar, and that's shelter. So that's going to be rent and homeowners rent equivalent, which is basically what does it cost to own a home? And we know that home prices remain elevated and interest rates have been higher. So it's still driven costs higher there. So those are the main areas of what we've been seeing driving inflation in the past and where we are today. Okay, so to wrap up the discussion on the economy, we're going to look at a handful of charts in terms of labor. So labor demand, this is a job openings. They call it the JOLTS. It's basically how many jobs are available for hire at this point. In March of 2022, it peaked all the way at 12,000. So we can see how much higher that is than where we've been historically. And that's because a lot of that COVID cash that they infused into the system allowed companies to hire more people. Of course, it also helped to drive inflation as well. But now we're down back to almost where we were pre-COVID. So I would say it's kind of normalized, if you will. Now that's almost a 35% drop. So it's not necessarily a good thing, but it's not necessarily an awful thing either, as we're really just kind of getting back to where we were pre-COVID. Now, if we look at quits, this is how many people are quitting their job. Now, what we're seeing fewer people quit their job, and that may seem like maybe a good thing. However, it's again not necessarily a bad thing. But when people quit their job, they do so because they find it very likely that they'll find a better job if they quit. So the fact that that a lot fewer people are quitting, that kind of tells you that the labor market's tightened up quite a bit because their other job prospects aren't nearly as high as they used to be. And then if we look at layoffs, they still remain low historically, but we've seen a little bit of an increase over the past couple of years in terms of layoffs, but certainly nothing that's super alarming at this stage. So we're going to continue to keep an eye on that as we move forward. And then just in terms of labor supply, a few interesting things to point out here is labor force participation. So what percentage of folks are participating in the labor market and have jobs? If we look at this gray bar here, right around 63%. Pre-COVID, we were a little north of 63%. Obviously, that crashed during COVID and has been working its way higher, but it's not quite back to where we were before COVID. So there's fewer workers in the economy than there was pre-COVID. And we'd like to see that this gray bar continue to trend higher. Now, people aged 84 or 18 to 64, that's the bulk of the labor market, right? That's when people are generally working. We have seen those folks actually at a higher rate than we were pre-COVID. So that's pretty good to see. Now, this is kind of an interesting thing. If we look at foreign-born versus native-born labor force growth, since COVID, you can see here in the blue that the majority of labor force growth has gone to foreign-born workers. And so, that tells us that they're probably lower paying jobs in that sense. At least a lot of them. You obviously have a lot of foreign-born workers that are great engineers and things like that. But generally speaking, if we see a higher share of foreign-born workers driving labor growth, it's probably in the lower paid job, on the lower paid side of things. Now, to wrap up, this is payroll gain, so just number of job growth per month. And we can see that's steadily been trending down since peaking in the middle of 2021. So kind of once that COVID money infusions kind of started to stop, companies have been hiring less. And, it's certainly not at a bad point. Typically, we like to see about 200,000 job gains per month to be what we would consider to be a really strong labor market. So we've certainly been lower than that for, I would say, the second half of this year. So nothing that is necessarily raising alarm bells, but if that trend continues, that's where we may, start to see the economy continue to soften and slow at that point. So with that kind of wraps up our economic discussion. And I'm sure nobody's following the election at all. That's to no interest of anybody. Of course, I'm joking. So we want to know what's it like and what does it mean to us as investors as we invest in election years. And so with that, I am going to pass it back to Shane.
Awesome. Thanks, Drew. So here we are, we're 19 days out from the election. So our goal and aim here is to give you a historical reference of what it's like historically. We pulled a lot of data points together that give us some context and frame of reference of how the markets digest election cycles in the election years. So on our chart here, on the upper left here, it talks about real GDP year over year change annually. And it's color coded. So for the folks that can see in color, unlike Mr. Evan Barnes, we have the Republicans that's been 10% of the time going back from 1947 to current day, where the Republicans have been in control of, let's say, our government. And then the Democrats on the blue bars represent 30% of the time there. And then the remaining amount here is our divided government. And more than anything, this shares with us that real GDP has done just fine, regardless of that Republican or Democrat. But when we have a divided government, it actually tends to do a little better than any type of majority. Similarly, in that vein, as we look at the S&P price index, this is just a continuation of that. But 61% of the time, again, we've had a divided government, and the S&P has fared just fine at 8.3% average return, 61% of the time there. So having a divided government seems to be a major theme as we look at how Wall Street views government. I would say this is by far my favorite slide that we've covered. We even had this on our Q1 webinar, and this remains probably my favorite slide when it comes to politics. So how to interpret and read this slide is going back to 1945 to current day, and it looks up how our government has divisions of power and what does it look like how our government is made up. So when we have a Republican president, Republican Senate, and a Democratic House, that's happened 10 times since 1945 to current day. And the S&P in that time period has done 19.7%. So when we digest that, it makes you curious. It's like, well, what's happened if we've had, let's say, a majority on one party or the other all across our divisions of power there? So when we look at where we have Democratic president, Democratic Senate, and a Democratic House, a little further down, all D's across the board there, that's happened 24 times. And the S&P return's been 13%. If we've had a majority of Republicans all the way across, that's happened 6 times, and the average rate of return is roughly 13%. So when we digest all this information, more than anything, what Wall Street cares about is they want to know the rules of the road when it comes to our legislation and how that'll affect specific businesses when it comes to policy. So more often than not, if we have a division of power, Wall Street digests that as a good thing, different than how you and I would probably digest elections where we probably have one affiliation one way or the other. But the way our system is set up is if we have a balance of power there, knowing that Wall Street says we like to know with certainty how the rules of the road will be legislatively going forward. Okay, so we mentioned just a minute ago that we have an election coming up in 19 days. So on the left-hand side here, this shares with us, kind of looks like a heartbeat, an EKG. And when we look at this, this is volatility leading up to an election day. And the reason for that is Wall Street is trying to digest of how they think things will shake out when it comes to an election. Perhaps an example of that is there's been rhetoric and talk about changing the corporate tax code. There's been talks about what if there was universal health care across the board and how that would change private businesses. So that uncertainty and volatility leading up to the election is kind of some turbulence leading up to the election day. But once we have the election day finalized and Wall Street can digest that information and say, here is what it's going to look like going forward, typically they have wonderful returns post-election day historically. And the two of those that are down, and then we look at that, though, it's 2008 financial crisis with lending, and then the tech bubble of 2020, or yeah, of excuse me, 2000. Those are the two times where markets were down. But other than that, we've seen really wonderful returns after the election day has happened. And so on the right-hand side here, if we go back to 1936, the current day, when we look at Q4, there the median return post-election there is up positive 3%. And then the average, call it 2.5%. So once Wall Street digests and knows here's how our government is formatted, then they can really take that uncertainty out and really start moving forward. So Drew talked about, fixed income. I talked about equity markets. So most of our clients have some type of portfolio that's diversified, where it's not just all equities or it's not just bonds. So when we look at a 60% equity portfolio, 40% fixed income portfolio, what has that looked like historically when we go back on election cycles, starting with Reagan to current day? So 9 out of the last 10 election years, a 60-40 portfolio during that election year has done on average 6.8% rate of return. So that shares with us more often than not, our 60-40 portfolio is going to be positive. So there's really been one time in that time period since 84, and that goes back to the 2008 financial crisis, where that was just an awful time. But when we look at that historically, we have seen really wonderful returns on a 60-40. And then the white bars represents is what happens in the 3 years following an election. So when we look at that annualized, that on an election cycle, we're up 10%. So taking that into consideration on a 60-40 portfolio, that is a wonderful rate of return when it comes to that. And I found this little point interesting, that same portfolio consistently delivered positive returns 100% of the time in the 3 years following an election year. So once we've had that election cycle and Wall Street settles in, we've seen wonderful growth post-election. So we covered a lot of ground today, going from the equity markets to fixed income to economic update, and then even tackling the election. We're glad you all tuned in with us, and we'll go ahead and jump into our Q&A section here. Looks like we got a couple questions pending. Oh, looks like we had technical goods there. Thanks, Mr. Heron, for letting us know about that. If you have any questions or thoughts, now would be a great time to go ahead and share any of those, and we'd be glad to answer them for you.
So we'll give a few minutes to see if anyone does have any questions. Okay, so it sounds like the audio issue was not on our end, so that's good. I think the key takeaway is that through 3/4 of this year, the markets have done quite well. So of course we're pleased with that. They've done better than average during a normal election year. And I think the main takeaway as we're down this home stretch in the election is that as investors, we want to be sure to strip out our political preferences and our emotions about that from the decisions we make as investors, because as Shane shared with us, regardless of the makeup of government or which party wins, the presidency or the House or the Senate, the markets do well moving forward. The economy does well moving forward. And so we don't want to try to play the timing game based off of who we think may or may not win. And then same goes for post-election. Once we know who wins, that doesn't mean we want to make drastic changes to the portfolio because our guy won or lost, or gal. So main takeaway is as investors, we want to stay the course regardless of how elections play out. This has been a pretty exceptional year in terms of portfolio returns. And with that, it doesn't look like we've had any questions come in. So thank you so much for your time. We know how valuable it is, so we're grateful that you spent your lunch hour with us. So we will be recording this webinar and we will be sending it out. So if once you see that email hit, if you do have anyone you want to share it with, please do forward that along. And with that, we may have just had a question come in. Let's take a look here. Okay, so here's a question. How is the conflict in Israel affecting things? Well, that's a relatively loaded question, I would say. But from an investment perspective, we've seen the markets just kind of trudge higher all throughout this conflict. So from a market perspective, we really haven't seen, if there's any big change in the conflict, we might see some volatility for a day or two, but the market has ironed that out pretty quickly and easily and moved on to new highs. I will say the one major impact is we have seen oil prices increase since then. And as oil prices increase, we know what that can do to inflation. And so maybe that makes inflation stick around in a little more stubborn of a way than the Federal Reserve may want it to. So there's a chance it may have them slow their forecasted path of interest rate cuts. But that's really the only main impact we've seen to this point.
And even with, the war in Ukraine has been going on for a while too, and the market has already priced that into it. And markets, as we know, are very forward thinking, and they're generally pricing the market out, 6 months to a year in advance. So that's already baked into where the market is currently.
All right, and it looks like that is the last question that we have, and you folks saying thank you for the information, and we're more than happy to have spent this hour with you. So thank you all for joining. Again, we'll get that recording out in relatively short order. And with that, we hope you enjoy your afternoon and the rest of your week. And if there's anything we can do, of course, to help any of you, just give your advisor a shout and we'll be sure to help. So everyone have a great rest of the day, and thank you very much. Take care.